Welcome to this explainer. Today, we're stepping into the role of a specialized analytical engine to totally deconstruct the exact mechanics of wealth accumulations through rental property. And based on some extensive expert financial reporting, we are skipping right past the surface level storytelling and that generic personal finance advice you've probably heard a million times. Instead, we're diving deep into the direct cause and effect relationships and the highly non-obvious tax mechanics that the wealthy actually use to aggressively compound their capital. So, why does this matter to you? Well, because understanding the profound difference between simply trading your time for a paycheck and mathematically architecting a true financial empire, it changes absolutely everything about how you build your future. If you really want to know how this system operates under the hood, you are in exactly the right place.
Okay, let's lay out the roadmap for today. We're going to examine the concurrent financial plans on which real estate operates. That means covering the mechanics of leverage, the phenomenon of phantom expenses, accelerated depreciation strategies, shielding active earned income, and finally, indefinite tax deferral. All right, let's kick things off with Section 1, the mechanics of leverage. We have to begin our analysis by looking at the fundamental application of fractional reserve banking to real estate. This is the bedrock of the entire asset class. It allows you to control a massive appreciating asset with only a minimal amount of deployed capital. Unlike traditional stock investing, where you generally have to pay for the full asset up front, dollar for dollar, real estate is fundamentally structured around other people's money, specifically bank debt. And the mathematical reality of this leverage is just staggering. Think about this specific equation from institutional models. Imagine you save up $50,000 for a down payment on a $500,000 property. Even though you're only putting down 10%, you control the entire $500,000 asset. Now, if the broader market appreciates by just 10%, your property is now worth $550,000. That $50,000 gain, that represents a literal 100% return on your initial invested capital. But the mechanics go even deeper when you factor in inflation. Because you hold a fixed-rate mortgage, inflation actively erodes the real value of the debt you owe the bank. It makes your monthly payments cheaper in real terms over time, all while your underlying asset inflates in value. You're quite literally utilizing bank leverage and systemic inflation to exponentially multiply your personal wealth in a way that unleveraged investments simply can't match. Moving right along to Section 2, yield and phantom expenses. So here is the core, non-obvious insight of this asset class. There is a massive dichotomy between real-world value and tax code treatment. A lot of novice investors focus entirely on the physical cash flow, the actual rent hitting their checking account every month. But when we deconstruct the numbers, physical rent really just keeps your operation running. The true wealth generation happens on paper. The data shows us that a well-bought property generally appreciates in the real world while concurrently depreciating on paper. This generates what financial strategists call a phantom expense. Now, you might be wondering, why on earth does the tax code allow this? Well, it's not a mistake, and it's not some shady loophole. The government intentionally uses the tax code to incentivize private individuals to provide housing. Because the government desperately needs you to provide shelter for the population, they reward you with a built-in feature, paper depreciation. In the real world, your property's market value goes up, yet the tax code acknowledges that physical structures technically experience wear and tear, right? Roofs degrade, HVAC units get older, flooring wears out. Because of this structural reality, you're granted a massive paper deduction, allowing you to offset your actual tangible rental income. You are essentially handed a legal tax deduction for a loss you haven't actually suffered financially. It's brilliant. By default, the IRS allows investors to mathematically deconstruct a residential building's physical structure over exactly 27.5 years to lower their taxable income. For commercial buildings, that timeline stretches to 39 years. But wait, there is a critical, actionable insight here. This deduction only applies to the building structure itself, not the land. Land doesn't mathematically wear out. Dirt is just dirt. So if you have a $400,000 property, but the land is worth $100,000, you only divide the $300,000 structure by 27.5. That gives you an annual phantom expense deduction of nearly $11,000 to shelter your rental income. And here's a crucial, non-obvious detail. Improperly deducting the land value is an amateur mistake that frequently triggers IRS audits. You absolutely must secure a proper appraisal to strictly separate the depreciating structure from the non-depreciating dirt.
Which brings us to Section 3, Accelerated Depreciation Strategies.
The real turning point in this analysis is realizing that waiting almost 3 decades to fully realize your tax deductions is just highly inefficient if you're aggressively scaling a portfolio. This is where advanced tax strategy enters the chat. Instead of waiting 27.5 years, advanced analytical levers can compress that timeline to generate massive upfront capital. By executing what's known as a cost segregation study, investors stop treating the property as one giant single structure. Instead, they hire specialized professionals to conduct an intensive, engineering-based analysis. I mean, these engineers will literally walk through the property and map out every single light fixture, ceiling fan, appliance, and linear foot of baseboard. They intentionally isolate these short-lived items and legally reclassify them into drastically shorter 5 or 15-year depreciation schedules.
And it gets even more significant. Under recent 2025 legislative updates that fully restored 100% bonus depreciation, these newly segregated short-term components can be entirely written off in year 1. Think about that. Reclassifying just 20 to 30% of a property's internal components through this engineering study can entirely wipe out your taxable rental income in the very first year. Instead of taking a small, slow drip of tax relief over 3 decades, you intentionally force a massive year 1 paper loss. This whole maneuver is entirely about the velocity of money. By keeping those thousands of dollars in taxes within your own ecosystem rather than sending them off to the government, you generate immediate liquidity. You take the $50,000 you saved in taxes today and use it as a down payment for your next property tomorrow. It creates this absolutely unstoppable, compounding snowball effect. Let's jump into Section 4, Shielding Active Earned Income. Now, we need to address a massive implicit assumption out there, the widespread belief that passive real estate losses can only offset passive real estate income. For high-earning professionals, this feels like the ultimate hurdle. They generate massive W-2 or 1099 income from their day jobs, and they desperately need a way to shelter it. Looking at the institutional models, we can clearly see the absolute disparity in strategies between an amateur and a professional. Let's compare 2 scenarios. Think about Investor A. Investor A focuses purely on cash flow, working hard to generate $8,000 in profit, only to pay nearly $3,000 in taxes because they're in the highest 37% bracket. They sweat for every dollar, only to hand a third of it right back to the IRS. Now consider Investor B. Investor B deploys financial engineering, utilizing accelerated depreciation to create a $21,900 paper loss. Not only does Investor B pay 0 taxes on the property's actual cash income, but they use that massive paper loss to offset their active day job income. They are literally transforming their previous W-2 tax liabilities directly into reinvestable capital. It's a total game changer. To unlock this incredibly powerful active income shield, high-income earners rely on specific, rigorous tax designations. The most potent of these is real estate professional status, or REPS. However, our analysis reveals a critical, non-obvious detail. Because this is essentially a golden ticket to wealth, the IRS watches it like a hawk. It requires strict, unassailable compliance with specific criteria. You can't just guess your hours. You must meticulously track spending at least 750 hours a year in real estate activities, ensure more than half of your total working hours are in real estate, and prove material participation. This means maintaining detailed spreadsheets or tracking apps, logging every single email, contractor call, and property tour. Actually, very often, if one spouse is a high-earning doctor or executive, the other spouse will take on the job of fulfilling the REPS criteria. This allows them to jointly shelter their massive active household income using real estate paper losses. But hey, what if REPS is completely unattainable because both spouses have highly demanding full-time careers? Well, the short-term rental exception offers a brilliant secondary mechanism. By operating a property where the average guest stay is 7 days or fewer, think something like an Airbnb, and meticulously tracking at least 100 hours of material participation, you can entirely bypass that grueling 750-hour reps requirement. For example, a surgeon making $500,000 a year could buy a mountain cabin, actively manage the booking calendar, and coordinate with cleaners for just over 100 hours a year. They can then legally use the massive accelerated paper loss from that cabin to wipe out $100,000 of their primary surgical income tax liability. It is a highly specific compliance loophole that creates staggering immediate wealth velocity for busy professionals. And finally, Section 5, Indefinite Tax Deferral. Let's move to the final layer and see how this entire engine builds into an exit strategy focused on perpetual, generational wealth preservation. We've established how to acquire with leverage, how to depreciate, and how to aggressively shelter income. But what happens when the asset has served its purpose and it's time to sell? If you just sell the property outright for cash, the IRS is going to hit you with massive depreciation recapture taxes, often at a steep 25%. They basically demand back all those brilliant tax benefits you previously claimed. To bypass this entirely, expert investors deploy the 1031 exchange. This allows you to roll your capital gains and defer that depreciation recapture indefinitely, provided you reinvest the profits into a new like-kind property. Think about the mental math here. Selling without a 1031 means the friction of tax erosion leaves you with only 75% of your wealth to buy the next property. Using a 1031 means you roll 100% of your equity forward. Over a 30-year investing timeline, that exact mathematical divergence is quite literally the difference between retiring as a millionaire and retiring as a billionaire. This all culminates in the ultimate institutional framework, often referred to by wealth strategists as buy, borrow, die. You buy the appreciating asset, but instead of selling it for cash and triggering a taxable event, you extract liquidity by taking debt against the newly generated equity through a refinance. And here is the absolute non-obvious secret. Debt is completely tax-free. If you pull $100,000 out of your property via a refinance loan, the IRS cannot tax it because it is borrowed money, not earned income. You get the cash to spend or reinvest, you avoid selling the collateral, and your tenants continue paying down the new loan. Finally, upon your eventual generational transfer, your heirs receive what is called a step-up in basis. This brilliant mechanism completely wipes out the entire historical tax liability and depreciation recapture of the property. It creates a mathematically airtight seal around your multi-generational wealth. When we step back and view this engine holistically, the silent truths of the asset class become absolutely undeniable. Physical rent pays the operating expenses, satisfies the bank's mortgage, and keeps the financial engine running day to day. But it's the sheer mathematical manipulation of the tax code, leveraging phantom expenses, forcefully isolating components for strategic paper losses, and utilizing the power of perpetual tax deferral that truly constructs lasting, exponential wealth. So, when you look closely at your own financial engine and your daily grind, ask yourself this critical, challenging question. The rules of wealth accumulation are already written into the system, operating entirely on cold mathematics and strategic foresight. Are you going to continue trading your time for fully taxed earned income? Or will you use the analytical architecture of real estate to mathematically engineer your own financial freedom? Keep analyzing, keep optimizing, and we will see you in the next explainer.